and I'm delighted to be welcoming you all to this webinar, looking at the relationship between sustainability and profitability with our strategic partners CRIF as part of the inaugural Sustain Festival. Better Insurance Network is a global community of insurance professionals with a focus on sustainability who believe insurance has a crucial role to play in enabling the transition to a more resilient, sustainable world. Our mission is to raise awareness of the strategic drivers and opportunities for the industry around sustainability. This year, we've launched the first Sustain Festival, a global collaboration of the insurance industry and key insurance adjacent companies like our good friends here today at CRIF, spotlighting the role of insurance in the transition, building momentum and accelerating innovation. Today's webinar, led by Mattia Bongini, Data Science Manager at CRIF, will focus on the relationship between sustainability and profitability, highlighting how encouraging sustainability in clients has a direct positive correlation with loss ratios. We will have some time following Mattia's presentation for some questions at the end. So if you have any and wish to ask Mattia a question, please pop it in the chat and we'll do our best to get those answered before we finish. If time is tight and your question isn't answered, a member of the CRIF team will reach out to you directly. We'll also be dropping a link to a survey in the chat towards the end of the presentation, and we'll greatly appreciate your feedback. The webinar will be recorded and made available on demand on the Sustain Festival website. Finally, having partners like CRIF joining us for the Sustain Festival makes real important change possible. So, Mattia, I'll hand over to you now.
Thank you very much, Tom, for the kind introduction. So, as you were saying, today we are going to deep dive into this topic of enhancing profitability in commercial insurance. To do so, we will have three chapters. First, we will deep dive about how to integrate a sustainability assessment into commercial underwriting, trying to see what kind of data we can embed real time into this process. Then, in the second part, we will see how we can assess whether this kind of data correlate with insurance risk, and this means whether we can use them actually as drivers in order to understand, in order to measure sustainability and increase profitability. In the last part, we will focus on how to improve loss ratio by using the data that we have collected and see how we can enhance their performance. So let's start from the first part. In order to start, we would like to begin with a result of a survey that we, CRIF, together with Insurance Post, have submitted to insurance companies, where we were we were testing, let's say, the ESG preparedness of the industry. In this first question, we were actually trying to understand if insurance companies were already embedding ESG data in their organization, product and service development. And the result was positive, in the sense that most of them were already at least partially embedding this kind of data inside their decision process, which is a very good, let's say, start, because this is a long journey. So we understood that many insurance companies already understand that this is the path going forward. Of course, we went a little bit further, asking them what kind of climate change risks they were currently evaluating into their pricing and underwriting. And without much surprise, we understood that insurance companies were very good covering the so-called physical risks, which is basically their bread and butter. So they were already very advanced in assessing, for instance, physical damage caused by floods, physical damage caused by storms and hurricanes, heat, cold waves, and so on. So all this kind of physical risk on which insurance companies have lots of data to fine-tune their model. The kind of areas where insurance companies were much slower in adapting and adopting this kind of data were topics like carbon emissions and external accreditations and so on. So let's say all the data that qualify the impact of a company on the environment rather than the impact on, let's say, of the environment on the company. Actually, this kind of divide that I was telling you before has a very specific characterization in the so-called double materiality assessment of companies, where we speak about the dependency part, that is the impact, or called also outside-in impact. So the impact of the society and the environment on the company, and here physical risk is certainly one of the primary drivers of this kind of topic, let's say. On the other side, there is the impact part, that is the impact of the company's activities on the environment and society. Examples of this kind of phenomenon are greenhouse gases emissions, prevention of modern slavery, and several other topics which we will touch upon in this presentation. Because this is where actually sustainability, it is a very important part of sustainability, which measures the behavior of the company, and which is the one where we will focus today. Okay. Of course, in order to measure this impact part, insurance companies, like everybody else, need data. Okay. But not, let's say, and this kind of data is not very easy to find, because this kind of data usually is available in sustainability reports, from let's say in a reported way, and sustainability reports are only available for only very few large companies, so leaving outside the vast majority of the population of companies. So obtaining this kind of data from SMEs is very difficult, because there is a lack of incentives or issues with brokers, let's say, in the collection of this kind of data, because this is usually done through questionnaires, and which, of course, it's a lengthy process for SMEs, which may not have neither the expertise nor the resources to do so. Moreover, questionnaires also have the issue that the collection is not a fast process. Okay, so while instead insurance companies need this kind of data embedded within real-time pricing models. So they need it, let's say, right when there is the quotation. That's why there is the obvious need at this point, let's say, to rely on statistical data to measure this kind of behavior. However, there is another issue in this sense. There is no single coherent data source or all the aspects that needs to be measured from an impact point of view, even from a statistical point of view, let's say. And moreover, this kind of data needs to also be homogeneous in terms of transnational, let's say, transnational level, because large insurance companies usually belong to large insurance groups and need to, let's say, assess this kind of metrics on a consistent basis. Okay. So these are all challenges, all very real. So it's not easy to, let's say, overcome them. But let's start from the basics. Okay. So in order to understand how we can find a way out of all these problems, let's start from the very basics. So what are the data which are typically available as underwriting for each company? Okay, so usually the kind of data which are available are the three that you see at the top of the slide. So registration number of the company, the SIC code, meaning the economic sector activity of the company, and the address of the headquarters of the company. Okay, all these data points can be used in a specific way in order to retrieve potentially useful ESG data. For instance, the registration number is typically used to retrieve, first and foremost, business information from company's house, which is, let's say, a very, let's say, in an incidental way, is a very good source of ESG information, as we will see. Not first-hand ESG information, but derived ESG information. Moreover, the registration number can also be used to check the presence of the company inside third-party databases which are connected to sustainability issues. We will see a few in the next slide. The economic sector of activity instead can be used to proxy sectoral ESG behavior, like in areas typically linked to emissions, employee relationship, and so on, because there are several databases which are very, very strong from a statistical point of view, like Axiobase or the Office for National Statistics or Eurostat for what concerns European companies, which are all very, very solid in terms of their statistical significance and explanatory power. Finally, the address of the headquarters is, we all know that this is most relevant for physical risk evaluation. However, it can also be used to check for geographical factors not necessarily linked to physical risk evaluation, like the operations near natural areas, so which impact like things like biodiversity, but also other indicators which have a geographical, let's say, aura, let's say. And these kind of indicators can typically be obtained by means of projects like Copernicus, OpenStreetMaps, and so on. Okay, but let's go step by step. Let's start from the registration number and the third-party databases. Which kind of databases can be typically used for this kind of ESG evaluation? Well, there are several. Okay, there are several which are UK specific, like the database associated with the Modern Slavery Act of 2015, which covers multiple aspects of the modern slavery documentation. So one can check whether the company has issued all the documents related to modern slavery, so it is compliant, which is already relevant information. There is the Health and Safety Executive Database, which covers HSE breaches and convictions from official sources. So from this kind of database, we can obtain negative information like infringed regulation, severity of the breach, and so on. So information that can be used to potentially penalize a company from sustainability. And of course, there are also international databases, mostly related to human rights and very general, let's say, human rights, let's say, issues, topics, like the database of the Business and Human Rights Resource Center or the OECD database, which can be queried in order to understand if the company is associated with allegations against things like human rights breaches or breaches of the OECD guidelines. Finally, there is Companies House, as I was mentioning before, which is the official register of the United Kingdom for companies, and which contains financial statements, director information, regulatory filings, all, let's say, data which from, let's say, an outside perspective, they are not necessarily related to ESG topics, but actually we will see in the next slide that several of this information can be twisted, used in order to create, for instance, governance indicators. For an take from, let's say, the list of directors, indicators that we can create from them. So indicators like the average age of the director, of the board of the directors. This means this indicator is typically used in the sense of to test if the management is sufficiently resilient, because typically a very old board of directors is less, let's say, dynamic and adapt to answer potential threats and from a business point of view, while younger board of directors may be more energetic in this sense. Then there is, for instance, the gender gap of the board or the gender of the CEO, which are indicators that are related to the inclusiveness of the company. So to measure how inclusive they are of women and other minorities. Then there is the capability to measure to test if there are potential family ties by looking at the list of directors. Of course, this is usually a typical indicator of transparency and of resilience, because potential family ties may be detrimental to the capacity of the company to overcome several difficulties. Then there is the number of corporate officers, which, of course, the larger the board, the higher the accountability usually is of the board members. And another measure which we can derive is the locality of the board of directors, so the percentage of members living close to headquarters, which is again a measure of how close the company is to its neighborhood, so to the people living in the society where the company operates. So these are all examples of indicators that can be created and which have a very easy ESG interpretation. Okay. Then, of course, we can also use the other information which you can find in company's house, like the economic sector of activity and the address of the headquarters, to derive other ESG indicators by means of analytical models applied to open statistical data. Again, without the need to interact directly with the company. So we are at the moment, we are just speaking about doing things in an automatic way without any interaction. Okay, so we can use the economic sector of activity and financial information in order to estimate the greenhouse gases emissions scope 1, 2, and 3 on the environmental side, but also the percentage of renewable energy usage, the percentage of energy recovery, and so on. But also on the social and governance side, we can create several ESG KPIs, like the number of employees per manager, the lost time injury frequency rate, the gender pay gap, all information which we can estimate for any given company, starting from the data that we have collected from company's house or from underwriting data. So, wrapping up a little bit what we have, the journey that we have so far. We started from the typically available underwriting data about the company, which are the registration number, the SIC code, and the address of the headquarters. If we have the registration number, then we can check inside third-party databases regarding positive or negative ESG information, and we can also do a business information enrichment through company's house. Instead, because it happens that the registration number may not be available, however, if we have the SIC code and the address of the headquarters, while we cannot do, let's say, the steps 2 and 3, so check inside third-party databases and business information enrichment, we can still reach the fourth stage and compute at least part of the analytical ESG indicators that we have mentioned before. While instead, if we have the registration number, we can compute all of them because, of course, we have much broader information regarding the code. So we have a pipeline, okay? We now have a pipeline to enrich this kind of ESG data. Of course, this pipeline has its pros and cons with respect to the typical data that are obtained from questionnaires or sustainability reports. The pros of this pipeline is that it is fast. It's certainly fast because when we have the input data, the computation of those indicators can be done quickly if the pipeline is well structured and there is clever data management. Okay. The coverage of this kind of pipeline is potentially limitless because there is, beside the availability of underwriting data, there is, and of course, and even in this case, of course, we don't even need all the data that we have said before in order to compute at least part of the ESG indicators. So there is really no limit regarding the potential coverage of this kind of pipeline. The other advantage is that the KPIs computed, the indicators computed from with this pipeline are based on authoritative sources and methodologies. Of course, if one develops this kind of analytics in a well-defined way, of course. And this is, of course, a very good advantage because it means that you are leveraging on the authority of the scientific community and the regulators in order to be as compliant as possible to what they say. And last but not least, this pipeline produces statistically significant indicators. So the data that we obtain from this pipeline can be employed to perform statistical analysis, which will be key topic that we will touch upon in the next two parts. Of course, there are also negative, let's say, traits for this pipeline. So, as we have seen, several of these indicators are statistical proxies because in order to have functional information, everything to be functional information, we would need to either go on the potential, if present, a sustainability report, which is only available for very few large companies, or wait for the questionnaire to be filled out. There is an initial investment, of course, in order to create this kind of pipeline because it's a lengthy process. There are a lot of databases to query and lots of models to implement. But of course, once this kind of investment is done, the pipeline is there. But of course, it needs to be maintained because indicators have to be refreshed periodically. Data sources need to be improved, and as well as methodologies. So, because the ESG topic it's a very frontier topic. So one needs to be at the cutting edge in order to be to have a solid pipeline. And finally, of course, in order to do everything, you need to have vertical ESG modeling competencies within your organization, which is usually typically not available everywhere. So it's a significant investment to undertake. But let's focus now that we have our pipeline with what we can do with this kind of data. As I said, statistical analysis between ESG data and insurance risk is now possible because we have a statistically significant way to enrich ESG data. Okay, so we start from our portfolio. Okay, actually we start from the portfolio associated with a specific line of business, because typically when we do this kind of correlation, the reasoning is to focus on each specific line of business as a standalone, let's say, as a standalone realm, basically. So we start with the portfolio associated with a given line of business, and we enrich this portfolio with the ESG indicators that we have defined with our pipeline, using registration number, SIC code, or the address of the headquarters. So once we have all these ESG indicators, we can perform correlation analysis with specific risk indicators of the line of business, which can be loss ratio, claim frequency, burning cost, so that we can create a short list of KPIs which are correlated with this kind of target variables. In order to do so, of course, we can use a combination of traditional and advanced machine learning techniques like random forest feature selection, Pearson correlation coefficient, and so on and so forth. So you have each of us has its own let's say arrows in the quiver with respect to this kind of methods. So I will not, let's say, cherry pick any of them. But all these let's say all these techniques have in common the capability of providing an univariate relationship between each indicator and the risk indicators to exclude multicollinear variables. Okay, so at the end of this process, we have, say, a solid short list of KPIs which are independent of each other and correlated with the risk indicators, which usually is claim frequency, but of course you may have your own internal, let's say, models to do so. But there is at least another step. Okay, it's the interpretation analysis, because correlation is not enough. Correlation is just the, let's say, conditio sine qua non. So the thing that needs to be there, otherwise you don't go forward. But once you have it, it's not enough, because you need the direction of this correlation to be in line with the interpretation of the ESG KPIs. To be more practical in what I say, consider greenhouse gases emission. Greenhouse gases emission has a clear interpretation, because the more emissions you have, the less sustainable you are. So you want your relationship between greenhouse gases emissions and your target risk indicators like claim frequency to go on the same way. So the higher greenhouse gases emissions are, the higher the claim frequency should be. So there should be a positive linear relationship between these two indicators. Of course, this is true for greenhouse gases emissions, but also for workplace accidents. If there is a correlation between workplace accidents and claim frequency, you want the relationship to be the higher the workplace accidents, the higher claim frequency. There are, of course, ESG KPIs which instead follow work the other way around. So like inclusiveness. So for instance, the percentage of women in the corporate board. You want the relationship to be the higher the number of women in the corporate board, the lower the claim frequency, because instead an higher number here means more sustainability. Okay, so the interpretation analysis is a key step in order to prune the short list of KPIs in a way that it is actually consistent. It lets, let's say, profitability speak with sustainability. You may wonder, of course, if I do everything like this, I will be left with very few number of KPIs. Well, it's not true. Actually, we have found out with several client projects that actually this kind of correlation holds true for several variables, not only on the environmental side, but also on the social and governance side. Here we report just a few. For instance, we already mentioned the greenhouse gases emissions, so we have seen, let's say, that a portfolio of companies who have a low greenhouse gases emission intensity, scope 1, so the direct emissions as a percentage of the turnover, it is typically associated with a loss ratio between 50 and 30% lower than the average of the portfolio. Okay, so in a univariate way, you have this very positive relationship. And the same is true, for instance, for the presence of an ISO certification 14001, which is an environmental management system certification. If you have such certification, you usually belong to a population whose loss ratio is between -20% and -10% lower than the loss ratio of the let's say of the average portfolio, average loss ratio of the portfolio. Okay. Of course, all these loss ratios are line of business dependent. The first line, so the greenhouse gases emissions, were related to a liability product, while instead this one of the ISO certification was related to a property net of nat cat product. Okay, so, and this is true, as I was saying, also for social and governance. So you'll find out that if you are a company with a high percentage of temporary workers, then your loss ratio is typically higher than the average of the portfolio. So again, you can link also negative information in this way. Okay, so we are at the end of this process, the one that we've seen in the last slide. We are left with for each line of business with several ESG KPIs which are correlated with insurance risk, and so we can use them. We can use them in order to improve loss ratio and to, of course, improve the sustainability of the portfolio. Because what as a data scientist, of course, the first thing I want to do when I have a lot of data is to create a model. Of course, especially in this case when I have target variables. So it's like it is it's like being it's a professional way of thinking. So what I do is to take the flat table which we obtain from the short list let's say the short list process that we have done before, and feed it into a training pipeline, which of course the training pipelines can be, let's say, as complicated as one wants. Typically we can implement a grid search for gradient boosting parameter optimization. It's usually the easiest, and it's a good trade-off between performance and capability of optimization. Okay, and with this grid search you develop an array of model that let's say for further evaluation to understand which one is the best. Indeed, you need to evaluate them, of course. Typically here our, let's say, recipe is to try to understand, to strike a balance between the stability of the fit, the predictive performance, the coherence with the ESG KPIs, the interpretation that we have seen before. We like to be parsimonious in terms of the number of KPIs that we use. We don't want to introduce too many variables because otherwise you have too much noise. And moreover, we need to empirically validate that the model not only, let's say, works in our intended way in terms of claim frequency or loss ratio, but also that it selects sustainable companies. Okay, so that, let's say, the score actually works in the way we want. Because in the end, if we follow all these steps, the the model that we obtain is, of course, will have a continuous output because the target variable is continuous, and it can be, of course, clusterized into a finite number of clusters to enhance the monotonic relationship between the final score and the risk indicators that we have selected. So we typically end up with 5 classes, but of course this is a design choice. So you can do let's say whatever you like here in this sense. So you can even, let's say, keep the indicator as continuous, but of course typically clustering is a good way. It's a typical way of doing things in a actuarial way. So the score that we obtain usually is from 1 to 5, as I was saying, where 1 means more aligned to ESG criteria and 5 means less aligned to ESG criteria. So now that we have our score, we can, whenever a company comes to us asking for a quote, we can compute the score. Okay, how can we use the score? Okay, so we know that 1 means more aligned to ESG criteria and 5 means less aligned to ESG criteria. However, after we have developed the model, we know that the population of let's say of cluster 1 will be typically, at least this is what we have seen in our projects, will belong to a population whose observed loss ratio will be 40%, around 40% lower than portfolio average. Okay, so also profitable, let's say, part of the portfolio. For this, let's say, then I can implement commercial actions in order to make my price much more palatable, let's say, to this kind of company. So I could decrease my commercial price or increase the discount in order, because I know that this kind of company is sustainable and it is also less risky. So I can do this kind of action with a light heart, let's say, without being too much worried, because the company that I am selecting is a very good corporate citizen, let's say. On the other hand, if the company that comes to ask me for the quotation belongs to cluster 5, then we know that this kind of companies will be less aligned to ESG criteria. But moreover, we will also know that this kind of cluster will be associated with a loss ratio increase of 60% with respect to the portfolio average. Okay, so bad from a sustainability perspective and bad from a commercial perspective. So here the typical action is to increase the commercial price to hedge against this potential increase in loss ratio, or to decrease the discount. In the end, these actions have a coherent outcome. So they will both improve the portfolio loss ratio, of course, because I'm hedging, let's say, the individual performance, statistical performance, of course, with my commercial actions, but also I will increase the share of ESG aligned companies, because I expect companies into bucket 1 to be flocking, let's say, to my company with the prospect of having a very good commercial price, while companies in bucket 5 will have a price increase, and so at least part of them will decide to move to another company which is not capable of discriminating this kind of dimension. Okay, so it's a sort of self-selection, adverse selection for other companies. To conclude, let's say, I wanted to give you an example, let's say, coming from a project that we have done regarding the application of this kind of score, to let you know a little bit, let's say, in practice how it works. Here we have 2 companies which are similar from a size point of view. They have both revenues of around 20 million euros. Company A is active in the economic sector of development and production of system for material handling and movement, while Company B is engaged in the printing, coating, and processing of metallic materials. Company A, from the ESG KPIs that we have, that we can compute with our pipeline, looks to be very promising, because it looks that we have computed the greenhouse gases emission and they are low. There is a certification. The company asked for government aids for energy efficiency improvement, but also on the social side, there is a health and safety certification. There is a high percentage of full-time employees. On the governance side, there are several patents which are filed from this company, and the company is operating in a low gender pay gap environment. So, exceptional company. Okay, so our ESG score, of course, for this company is 1. Indeed, no claims were associated with this company. Of course, this is a statistical relationship which turns out to be true for this company. On Company B, instead, the situation is completely opposite. Okay, we have very high greenhouse gases emission, no ISO certification, no government aids, no health and safety certification. So there is a typo there. Low percentage of full-time employees, no patents filed, and operating in a high gender pay gap environment. So basically the opposite behavior. Okay, so our ESG score turns out to be indeed the opposite cluster with respect to Company A, 5, and indeed, in the end, this company had 4 claims with the insurance company, so it was also not a bad and not a good, let's say, client. So, good corporate citizens, good client. Usually, the association works in this way. So, to wrap up. Okay, this was a very lengthy webinar, so I hope you stayed with me till the end. If you didn't, let's say there are here some key takeaways to bring home to get the main messages. Okay, the first takeaway is that open data sources analytics can provide statistically significant ESG indicators which can be computed directly from the scant information available at the right. Okay, so here really with very few information we can do a lot in terms of understanding the ESG profile of a company. The second takeaway is that since these indicators can be computed on the entire portfolio, they enable a correlation analysis with insurance risk. Experience show that many ESG indicators do indeed show such correlation. Okay, so in the end, this set of indicators which are, let's say, have a good interpretation in terms of sustainability and have a good correlation with insurance risk is not empty. So there are a lot of indicators that you can use in this way. So this leads us to the last takeaway. Mixing the best ESG indicators using advanced machine learning techniques leads to ESG scores which are useful both for pricing sophistication and sustainability assessment. So in the end, we can indeed create an ESG score which works as a good pricing tool and as a good, let's say, underwriting policy for sustainable companies. I thank you very much for your attention, and of course, I'm here in case you have any questions.
Wonderful. Thank you very much, Matteo. That's fascinating stuff. I think while we give the participants in the room the opportunity to put their questions in the chat, I might indulge myself and jump in with the first question. It's really interesting to see how the process works. I guess, has it been implemented? Have we seen insurance companies use this approach for pricing sophistication? Can you give some examples?
Yes, absolutely. The main example with which we have worked together is AXA Italy, which has implemented this kind of let's say service together with us, of course, with our help, and they are already using it with success. So this is already a success story. There are, of course, other companies which are employing this kind of pipeline. They all typically rely on external partnerships to do so because, as I was mentioning before, it's of course this is a make or buy decision basically in the end, but the make needs to be means that ESG is a focus for the insurance company, which may start to become the truth. Okay, it might start to become much more widespread, but up to now, the pressure, the ESG pressure on insurance companies was not enough to justify such an investment. So this is typically what we see.
Interesting. I think it's really important with these sorts of developments that the results can be seen in practice, and having organizations benefiting from improved ratios by taking these scores and understanding these processes is really important. If we're talking operationally, for an organization, how easy, how difficult, how complex is it for an insurance company to implement this pricing sophistication based on the wide range of ESG factors that they want to look at?
Well, if they rely on an external partner, Tom, the adoption is very easy because usually it's just a matter of fine-tuning the specific ESG score on the line of business, which are the focus of the insurance company, and then it's just a plug and play because, for instance, we have the capability to API this kind of models and to easily embed within the pricing process. So it's actually not very difficult to do after a first, let's say, fine-tuning phase dedicated to optimize with respect to the specific line of business and specific portfolio of the insurance company.
Okay, interesting. Now we have a question. Yay. We have a question in the chat from Ed Woolcock, who I believe was at our Sustainable Insurance Summit on Tuesday. Ed asks, could you expand at all on the process taken to map different sustainability metrics or criteria to potentially relevant LOBs? As you say, these will change significantly developing on the LOB.
Yes, so if I got the question, of course here this is something non-deterministic in the sense that it will depend on the specific portfolio and the specific line of business of the insurance company. But basically what we see is that there are at least some regularities, okay? So we typically see that greenhouse gases emissions are typically relevant on most line of business. So this is usually things that come out. This is a thing that comes out quite often. Then, of course, if you think about it, there are even ESG KPIs which are more related to the specific line of business. For instance, with respect to liability, we expect that if you have an ISO certification for health and safety, for instance, you will be much less risky from a liability point of view. Okay, so we expect the ISO certification for health and safety to pop up in this short list and to go in the right direction from an interpretation point of view. So there is on one side there are ESG KPIs which are widespread and which typically address, let's say, a way of working, okay, like greenhouse gases emission. And then there are line of business specific KPIs which of course, pop up depending on the specific line of business. I was just giving you a very easy example, but there are tons of them. Like, for instance, the one that we show here, the high percentage of temporary workers. Of course, if you rely a lot on temporary workers, you tend to care less about them. Let's call it that. Let's call it in this way. Okay, let's put it in this way. And indeed, this kind of loss ratio increase is indeed related to liability, as you see from the slide. So there is this kind of evidence.
Excellent. Any more questions in the chat? I'll keep an eye out while I give any more a chance to pop them in. Just a quick reminder that we have put the link for the survey in there. If you could take the minute to fill that in, that would be wonderful. Appreciate sort of the time and engagement that you guys have given us today. We at Better Insurance Network and the whole team at CRIF look very much forward to continuing this discussion in future sessions with more discussion. There's plenty to talk about. There's plenty to be covered. There's loads that we can do better, but insurance is making significant strides, and it's really lovely to be part of Sustain Festival and see all the efforts and innovations that the industry is bringing together. So I guess without any more questions in the chat, we should maybe wrap that up. Thank everyone for attending. Matteo, that was fascinating. It will be recorded, it'll be distributed, and if you come up with any questions, in an hour, in 2 hours, in a couple of days, feel free to reach out to the team at CRIF, and I'm sure they'll be more than happy to get in touch. Thank you very much.